If you've been into stocks, you might have heard of the term short selling. Quite a lot of investors are making good money out of it. You might want to get a taste of that too, and now you're considering short selling your stocks for profit. But take note, short selling comes with a lot of risks. Not only are you charged with money you can't see on normal investments, short selling also gives investors a skewed payoff. Most likely, you'll face a limited upside with an uncapped downside. To simply put it, you can theoretically lose an infinite amount of money. So should you try it out? Or is it best to avoid it? We'll answer these questions in today's video. Hey, welcome to Stock Market Mate. Today, we'll talk about the basics of short selling. We'll also discuss the strategies and risks involved in this money-making tactic. Make sure to subscribe to the channel and hit that notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. So what is short selling? Short selling is an investment or trading strategy that guesses the decline in a stock or other security's price. It is an advanced strategy that should only be performed by experienced traders and investors. Traders may use short selling as speculation, and investors or portfolio managers may use it as a hedge against the downside risk of a long position in the same security or a related one. Speculation carries the possibility of extensive risk and is an advanced trading method. If you're a beginner, you might want to avoid short selling unless you want to lose all your assets. In short selling, a position is opened by borrowing shares of a stock or other asset that the investor believes will decrease in value. The investor then sells these borrowed shares to buyers willing to pay the market price. Before the borrowed shares must be returned, the trader is betting that the price will continue to decline and they can purchase them at a lower cost. The risk of loss on a short sale is theoretically unlimited since the price of any asset can climb to infinity. Short selling has a high risk-reward ratio. It can offer big profits, but losses can mount quickly and infinitely due to margin calls. So how does short selling work? Short selling sounds like a fairly simple concept in theory. An investor borrows a stock, sells the stock, and then buys the stock back to return it to the lender. In practical terms, however, it is an advanced strategy that you can't even perfect. Short sellers are wagering that the stock they're short selling will drop in price. If the stock does drop after selling, the short seller buys it back at a lower price and returns it to the lender. The difference between the sell price and the buy price is the short seller's profit. That's how you can profit from it. You must be wondering, why do investors sell short when there are a ton of risks that are linked to it? Short selling can serve the purpose of speculation or hedging. Speculators use short selling to capitalize on a potential decline in a specific security or across the market as a whole. Hedgers use this strategy to protect gains or mitigate losses in a security or portfolio. Notably, institutional investors and savvy individuals frequently engage in short-selling strategies for both speculation and hedging simultaneously. Hedge funds are among the most active short sellers and often use short positions in select stocks or sectors to hedge their long positions in other stocks. Though short selling does present investors with an opportunity to make profit in a declining or neutral market, only sophisticated and experienced investors and traders should do it due to its risk of infinite losses. Now let's talk about the types of short selling. Basically, you can short stocks with three objectives in mind. First, you can do short selling as a hedge. Other than speculation, short selling has another useful purpose: hedging. This is often perceived as the low-risk option, and it's a more respectable avatar of shorting. The primary objective of hedging is protection, as opposed to the pure profit motivation of speculation. Hedging is undertaken to protect gains or mitigate losses in a portfolio. But since it comes at a significant cost, the vast majority of retail investors do not consider it during normal times. The cost of hedging are twofold. There's the actual cost of putting on the hedge, such as the expenses associated with short sales or the premiums paid for protective options contracts. Also, there's the opportunity cost of capping the portfolio's upside if markets continue to move higher. For example, if 50% of a portfolio that has a close correlation with the S&P 500 index is hedged, and the index moves up 15% over the next 12 months, the portfolio would only record approximately half of that gain, or 7.5%. You can also short stocks for a profit. Imagine a trader who believes that a certain stock is currently trading at $50, and it will decline in price in the next 3 months. They borrow 100 shares and sell them to another investor. The trader is now short 100 shares since they sold something that they did not own but had borrowed. The short sale was only made possible by borrowing the shares, which may not always be available if the stock is already heavily shorted by other traders. A week later, the company whose shares were shorted reports dismal financial results for the quarter, and the stock falls to $40. The trader decides to close the short position and buys 100 shares for $40 on the open market to replace the borrowed shares. The trader's profit in the short sale, excluding commissions and interest on the margin account, is $1,000. because if you subtract $40 from $50, you get $10. Multiply that with 100 shares, you'll get $1,000, which serves as the trader's profit. Lastly, you can also short stocks for losses. Using the previous scenario, let's suppose the trader did not close out the short position at $40, but decided to leave it open to capitalize on a further price decline. However, a competitor swoops in to acquire the company with a takeover offer of $65 per share, and the stock soars. If the trader decides to close the short position at $65, the loss on the short sale would be $1,500. If you subtract $65 from $50, you'll get a negative $15. Now multiply that to 100 shares, you'll have a $1,500 loss. Here, the trader had to buy back the shares at a significantly higher price to cover their position, which doesn't sound too good. The pros and the cons of short selling. Selling short can be costly if the seller guesses wrong about the price movement. A trader who has bought stock can only lose 100% of their outlay if the stock moves to zero. When you short a stock, you're exposing yourself to massive financial risks. One famous example of losing money due to shorting a stock is the Northern Pacific Corner of 1901. Shares of the Northern Pacific Railroad shot up to $1,000. Some of the wealthiest men in the United States went bankrupt as they tried to repurchase shares and return them to the lenders whom they had borrowed from. If you want to sell stock short, do not assume you'll always be able to repurchase it whenever you want, at a price you want. Stock prices can be volatile. On the other hand, strategies that offer high risk also offer a high yield reward. Short selling is no exception. If the seller predicts the price moves correctly, they can make a tidy return on investment. If done carefully, short selling can be an inexpensive way to hedge, providing a counterbalance to other portfolio holdings. Simply, you'll have the possibility of gaining high profits with little initial capital. However, beginner investors should generally avoid short selling until they get more trading experience. Timing is crucial when it comes to short selling. Stocks typically decline much faster than they advance, and a sizable gain in a stock may be wiped out in a matter of days or weeks on an earnings miss or other bearish development. The short seller thus has to time the short trade to near perfection. Entering the trade too late may result in a huge opportunity cost in terms of lost profits, since a major part of the stock's decline may already have occurred. On the other hand, entering the trade too early may make it difficult to hold on to the short position in light of the costs involved in potential losses, which would skyrocket if the stock increases rapidly. So when is short selling justifiable? For one, it's understandable when there is a bear market. The dominant trend for a stock market or sector is down during a bear market, so traders who believe that the trend is your friend have a better chance of making profitable short sale trades during an entrenched bear market than they would during a strong bull phase. Short sellers revel in environments where the market decline is swift, broad, and deep, like the global market of 2008-9, because they stand to make windfall profits during such times. You can also consider short selling when the technical indicators confirm the bearish trend. Short sales may also have a higher probability of success when the bearish trend is confirmed by multiple technical indicators. These indicators could include a breakdown below a key long-term support level or a bearish moving average crossover like the death cross. An example of a bearish moving average crossover occurs when a stock's 50-day moving average falls below its 200-day moving average. A moving average is merely the average of a stock's price over a set period of time. If the current price breaks the average, either down or up, it can signal a new trend in place. Many investors stick with long-only positions. For most of them, returns are simply not worth the risk that comes with short selling. It certainly plays a big role in the world of investments, and you can theoretically earn huge sums of money by placing short bets against a deteriorating stock. But if you're about to get serious by speculating with short selling, do remember to tread lightly. If you found this video helpful, kindly click the like and subscribe button. Also, you might want to leave a comment below. We love hearing from you. Thank you for watching, and we'll see you in the next video. If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!